Hi, I'm David Bodemer, the Editorial Director with National Real Estate Investor. I'm here at the Strategic Real Estate Investment Conference, and I'm here with Paul Comstock, who's the chairman of Paul Comstock Partners. Now, you just came off, we had a panel that talked about family office and its approach to real estate. So can you share with us a little bit of some of the insights that you had for the audience here?
Well, yeah, real estate is such a great tool for a family as an investment tool. And the reason for it is that it has all the characteristics that you really want to see multi-generationally expanded in a family. Mm-hmm. So for instance, if we have a portfolio of holdings, we even have opportunities for employment as the family comes up. If we have a property management firm, even if we're investing in passive funds to some degree, we have an opportunity for due diligence. Real estate's kind of an interesting investment for younger people to look at. It's all around us. They're engaged in it as they're buying a home. So it's a great opportunity for families in a multi-generational kind of wealth transfer setting to be engaged with. Not to say how attractive it is from a valuation standpoint as we transfer it down. Since it's an illiquid asset, it sometimes transfers from a tax standpoint at a value less than it's probably going to be worth not long down the future. So we think real estate should be a major part of portfolios of families as they're asset allocating amongst stocks or bonds. They clearly don't want to neglect the opportunity in real estate.
And as it's passing from generation to generation, are there particular issues in dealing with real estate that differ than other kind of asset classes?
Yeah, most of them are good. One of the nice things about it is that, as I mentioned, it's an illiquid asset typically, so you have to have an evaluation of it. In an evaluation, you have liquidity discounts that apply. And Congress, and rightfully so, are attacking certain kind of discounts that are maybe, are they there or really shouldn't be there. But in real estate, the market's very clear. If you own a building and you really can't sell it right away, you have it appraised, it's going to appraise lower than probably it would be actually worth if you sold it that day, because you can't. So that's one aspect. It transfers down usually from a tax advantage standpoint. Second thing is it's a long-term hold, so we don't have to make decisions every day on it. And so if we go through a circumstance like we had a couple days ago, Friday the market was down substantially, everybody was nervous what was going on. With real estate, what are we going to decide? To sell our apartment home? Probably not. We can't. But we could have decided that we want to get out of this volatile market and go to cash. Generally speaking, those kind of timing decisions in public markets are very expensive to the value of wealth. It actually causes more destruction of wealth than buying on the wrong location for the property for the moment. So we think real estate is so attractive in a family environment because it gives a long-term investment horizon by its nature, transfers on a tax advantage basis usually, has usually pretty good cash flow characteristics that we can build into it, and when diversified geographically, provides a very stable form of return for a family portfolio.
All right. Well, thank you so much. That gives us a lot of insight into how family offices approach this. So, and thank you for watching, and please stay tuned to more videos from coverage from our show.